All right, let's dive in. Today, we're going to put on our detective hats and grab a magnifying glass because we are tackling one of the most fundamental ideas in all of finance, audit evidence. I mean, really, think about it. You see a company report billions in revenue, but how do we know that's real? What's stopping them from just, pulling a number out of thin air? There has to be a system, right? A system that underpins our trust in the whole financial world. Well, that's the exact question we're digging into.
So, where are we getting all this info? Well, our whole investigation today is based on the official rulebook for auditors. It's a set of professional standards, and this isn't just some textbook theory. This is the real deal code that auditors have to follow to get to the bottom of things.
Okay, so let's start with the big why. Why do we even need this whole process? What's the point?
Right. The best way, honestly, to wrap your head around this is to stop thinking of an auditor as just some person with a calculator. Think of them as a financial detective. See, a company's financial statements, they're telling a story, right? A story about how much money they made, what they own. And the detective's job, it's to find clues to see if that story actually checks out.
And every single clue that this detective finds, that's what we call audit evidence. We're talking invoices, bank statements, emails, even going and physically looking at stuff. It's literally anything and everything they use to figure out if the company's story is true.
All right, so if our auditor is a detective, then we got to ask, what makes for a good clue? What's the difference between solid, undeniable proof and just hearsay?
So the official rules say that evidence has to have two key things going for it. First, it's got to be sufficient. That just means you need enough of it. You can't solve a mystery with one single clue, right? And second, it has to be appropriate. And that's all about the quality of the evidence. A fuzzy, out-of-focus picture is okay, I guess, but a signed confession? That's way better.
So what do we mean by quality? Well, it really just comes down to two things. First is relevance. Like, does this clue even matter for the case you're working on? And second, reliability. Can you actually, trust it? And this table here, it shows you exactly what I'm talking about. There's like a hierarchy of what's trustworthy. Think about it. A bank statement sent directly to the auditor from the bank, that's a way better clue than a spreadsheet the company just hands over. And of course, a signed written contract is always going to be more reliable than some verbal promise a manager made. It's pretty clear, right? The detective is always looking for the most direct, independent proof they can possibly find.
So what are these detectives even trying to prove? Well, they're testing these claims that the company's management makes, and in the biz, we call them assertions. They're basically the core questions behind every number. So if a company says, we've got $10 million of inventory in a warehouse, the auditor's job is to ask, okay, but does that warehouse full of stuff actually exist? Is it listed at the right price? Are you sure you've counted all of it? Every single number on a financial report has these built-in questions that need answers.
Okay, so that brings us to the how. We know it makes a good clue, but how does our financial detective actually get their hands on it?
Well, there are basically two main ways to investigate. First, you can test the controls. This is kind of like checking to see if the building's security system is working. Does the company have good procedures in place to stop mistakes or fraud? The other way is to do what we call substantive procedures. This is where the detective says, forget the security system, I'm going to go and check the vault myself. They go and test the actual items directly.
And to do all this, our detective has a whole toolkit of techniques. They'll use inspection, which is just what it sounds like, looking at documents or even physically touching the inventory. Then there's observation, where they just watch how the company does things, like counting its own stock. They can use external confirmation, which is basically calling up a third party, like a bank, to get the story straight. They'll recalculate stuff to make sure the math is right. And, a big one is inquiry, which is just a fancy way of saying they ask a ton of questions.
Okay, that's a lot of theory. It's time to make this real. Let's open up a couple of special investigation files and see how this all works in the real world. All right, case file number 1. This is a classic, the inventory count. So a company's books say they have millions of dollars worth of stuff sitting in a warehouse. How does our detective prove it?
This is where the job gets really hands-on. The rules are clear. The auditor has to physically go to the warehouse during the inventory count. They're not just standing there either. They're watching how the company does it. They're inspecting the inventory to make sure it's not, a bunch of broken junk. And this is the most important part. They do their own counts. They'll pick a few items and count them themselves to see if the numbers match up.
Okay, on to our next case file. This time, we're looking at how to get clues from outside the company, using a really powerful tool called an external confirmation.
So let's say our detective needs to know if a customer really owes the company $1 million. They can send what's called a positive confirmation. It's a letter that goes straight to the customer saying, hey, do you owe this company $1 million? Please write back and tell us yes or no. That's super reliable evidence. Now, there's a weaker version called a negative confirmation. That letter says, hey, if you disagree with this amount, let us know. Otherwise, we'll assume it's correct. You see the problem, right? If you don't hear back, does it mean they agree? Or did your letter just end up in the recycling bin? Big difference.
So our detective has been busy. They've gathered clues from inside the company, from outside sources, they've watched things, they've counted things. So what's it all for? What happens now? Well, it's time for the final verdict.
This really is the moment of truth. The auditor has to take every single piece of evidence they found, the strong clues, the weaker ones, all of it, and kind of put it all on the scales of justice. And they have to ask, does the weight of all this evidence actually support the story the company is telling?
And in the end, it all comes down to that one critical question we talked about earlier. The auditor has to look at everything and decide, have I collected sufficient and appropriate evidence to back up my conclusion? Do I have enough good quality clues? If the answer is no, well, the detective work just isn't done yet.
Because think about it. All this work, every single document they look at, every number they double-check, every question they ask, it is all leading to one single thing.
And that one thing is the audit opinion. That's the final verdict. It's the seal of approval that lets everyone, investors, banks, you, me, know that we can trust the numbers. That opinion, built on that foundation of solid evidence, is literally the bedrock of trust for our whole financial system. It's why this detective work is so incredibly important.
So that leaves us with one last big question. If all this evidence is the foundation of trust, what happens when that evidence is a lie? What happens when someone is deliberately hiding the clues or faking them? That's when the financial detective's job gets tougher than ever and, honestly, more important than ever. Something to think about.